Artificial intelligence is evolving at breakneck speed, but behind the sleek demos, viral chatbots, and headline-making breakthroughs lies a quiet war. It's not a battle over algorithms or model accuracy, it's a battle over infrastructure, the servers, chips, and power that make AI possible. And here's the shocking part. The real threat to the tech industry isn't that AI will fail, it's that building it could bankrupt the system that created it. Welcome to the AI infrastructure arms race. Let's start with what's happening right now. Across Silicon Valley, tech giants are pouring money into building the backbone of the AI revolution. Enormous data centers filled with high-performance GPUs, specialized chips, and vast energy grids to feed them. Microsoft, Google, Meta, and Amazon are leading the charge, spending at unprecedented levels. In the last 12 months alone, these four companies have collectively poured more than $250 billion into AI infrastructure, a figure larger than the GDP of Finland. Why? Because whoever controls the compute, the raw power that runs AI, controls the future. It's no longer about who has the best AI model. It's about who can afford to train it, scale it, and deploy it faster than anyone else. But this race comes with a massive cost, literally. Every new AI model requires exponentially more power, memory, and bandwidth. Training a frontier model today can cost hundreds of millions of dollars in compute resources alone. Add in the hardware, cooling, networking, and data pipelines, and the numbers get dizzying. To put it in perspective, OpenAI reportedly spends tens of millions of dollars per month just operating ChatGPT. Google's Gemini models consume so much computing power that the company has had to build new dedicated data centers around them, and Amazon is racing to upgrade its global network to handle demand for its AWS AI customers. This isn't just expensive, it's unsustainable. Because here's the catch. AI revenue isn't keeping up with AI spending. Most AI services today are offered at little to no profit. Companies are pricing aggressively to gain market share, not to make money. The problem is that every improvement in AI performance requires orders of magnitude more computation, and that means the costs grow faster than the returns. It's like running a marathon where every mile costs 10 times more than the last, and this is where the infrastructure arms race starts to look dangerous. Analysts are warning that we may be entering a capex bubble, a capital expenditure frenzy where companies invest heavily in infrastructure with uncertain payback periods. Goldman Sachs estimates that global AI-related infrastructure spending could exceed $1 trillion by 2027. That's bigger than the entire semiconductor industry today. The question is, can even the richest companies sustain that level of spending? There's also a geopolitical layer to this story. The U.S. government is pushing for domestic AI production and chip independence, fueling billions in subsidies for semiconductor plants and data center expansion. NVIDIA, AMD, and Intel are all racing to supply the chips that power the AI era. But even chip makers are warning that supply can't keep up. Demand for GPUs and AI accelerators has outstripped global capacity, driving prices sky high. That scarcity adds more cost pressure on the entire ecosystem and forces cloud providers to buy hardware years in advance just to stay competitive. Then there's the power problem. AI data centers are energy monsters. A single large facility can consume as much electricity as a small city. As companies scale up, local power grids are struggling to keep up. In states like Virginia and Texas, new data centers are being delayed because the power infrastructure simply can't handle them. And it's not just about electricity, it's about cooling and water. Some AI data centers use millions of gallons of water per day to stay cool. Communities are beginning to push back, questioning whether this level of resource use is worth the jobs and tax revenue these facilities bring. So, what does all this mean for the future of tech? In the short term, the spending will continue. No company wants to fall behind in the AI race. But in the long term, the economics of this model may break. The returns on AI infrastructure investment are starting to flatten while costs keep rising. This is leading to a new kind of competition, not over speed, but over efficiency. The next wave of winners in the AI industry won't be the ones who simply spend the most, but the ones who spend the smartest, those who innovate in energy use, model compression, and compute optimization. Companies like Cerebra's, Grok, and Anthropic are already exploring new architectures that deliver faster AI performance with lower power consumption. Even NVIDIA, the undisputed king of AI chips, is warning that compute efficiency, not brute force, will define the next decade of progress. There's also a shift toward modular AI, where smaller specialized models replace massive all-in-one systems. Instead of training 1 trillion parameter model to do everything, future AI systems might be networks of smaller models working together, faster, cheaper, and easier to scale. And for investors and policymakers, the question becomes existential. How much spending is too much? At what point does the AI dream start straining the global economy? Because the truth is, innovation can't defy economics forever. Right now, the tech world is caught in a paradox, the biggest opportunity in decades, powered by a business model that burns through capital faster than it creates it. The AI revolution is real, but so is the risk that it becomes a voltage vortex, a surge of spending and energy that pulls the industry toward its own limits. The next few years will reveal whether AI becomes the engine of a new economic era or the most expensive experiment in tech history. For now, the infrastructure race continues. The data centers hum, the GPUs blaze, and the bills keep rising. And somewhere in that noise, the future of technology and maybe the global economy is being rewritten.